Welcome back to the podcast. Don't forget to go to the website at retireyoungaudio.com and leave us a comment. Also, subscribe to the Retire Young podcast at Apple Podcasts, iHeartRadio, and Spotify. As we get into this last segment here, let's get into these retirement accounts as well again, because we have a lot of investors that are invested in the market, but they don't know what to do with their accounts, and the institutions, they're not giving them proper guidance and advice. I mean, a lot of the things is to help the institutions, not their clients. Now, what is the Roth IRA and the traditional IRA? Just explain what those are, just the terms. That way our listeners can understand that, and then how they can utilize that in on their own terms.
Yeah, they're both individual retirement accounts. A traditional IRA is one where pre-tax money goes into it. In other words, you haven't paid income tax on the money that goes into it, and everything that grows within that account. Guess what happens when you take it out? Because the government has given you the opportunity to not be taxed on the money that went in. Now they're going to require you to pay taxes on not only the money you put in, but all the growth of it. So everything that comes out of that IRA, a traditional IRA, is subject to income tax. A Roth IRA is contributed with after-tax money. So you've already paid the taxes on the contribution. And then what happens in the Roth is that all of the growth is tax-free. Everything comes out of the Roth tax-free. So the younger you are, the earlier you can set up a Roth IRA. The greater the return can be that comes out that's not taxed. And there may be some reasons that somebody would want to set up a Roth IRA as opposed to a regular, or a regular as opposed to a Roth. So and again, these are things that you need to understand before you decide which way to go. But both of them allow you to have many different assets. Both of them allow you to participate in upward moving markets, downward moving markets, and even sideways moving markets. Both allow you to have protection, this what we call an insurance policy on a portfolio within them. And what a lot of students do, if you have a 401k or 403b and there is a match involved, and by the way, a lot of companies now during this coronavirus issue have either stopped matching or cut back on the match. But if there is a match, that's free money. That's something that should be taken advantage of. But once the match has been met, the emphasis still, or the advice is still, put as much as you can into that 401k. And what we're saying is that what people are doing is putting money into something that is mediocre returns. That's the mutual funds. The mutual funds, with getting very little advice, but still paying fees. So with that self-directed IRA, maybe additional money that would have gone into the 401k can go into a self-directed IRA.
Why are options so phenomenal with those accounts? Because rather than just buying and holding a stock, which the broker would require a certain amount of capital to do that. Why would options be a good option to take advantage of?
Yes. Well, what's happened with a lot of stocks these days, the per share price has gotten so high that it's hard for a lot of people to participate with a decent size position. It used to be when the stock got up to close to $100 a share, it would split and bring the price back down, and more people could afford to get in. Now we've got a lot of these stocks that are trading in the $300, $400, $500, $2,000 range, which makes it hard to have a good position in the stock. An option is a way of mimicking a stock position with a much smaller initial investment.
That's what the brokers require.
That's
right.
Exactly right. So, there's leverage there. There's great leverage, which allows somebody to control more shares for less money.
It just means more buying power.
It's more buying power. You're maximizing the power of every dollar that you have. And then also from a return standpoint, kind of a rule of thumb with options is that if the underlying asset, and by the way, when you're trading an option, it's a contract on something that's an underlying, we call it. It's could be
like
stock.
A stock or an ETF.
Or an ETF. So you could have an option on individual stocks, an option on the markets in general, and then also options on futures or Forex. So a variety of things there. Options can be used for trading, investing short-term and long-term. and also for boosting the returns of a stock portfolio without having to sell any of the stock positions.
I'm really glad you dissect these other asset classes. You did the futures and the forex market, but especially these options market, options asset class, because they're so versatile. We see institutions and the most likely they're utilizing them for income. They're utilizing them for retirement accounts as well, and it's available to the public. And it's just understanding and learning what those are. Al, I want you to clarify. You mentioned insurance on portfolios. Everybody insures their cars, their homes, their lives. Nobody insures their portfolio. Why is that so important? But it's utilizing options, correct?
Sure. A put option is basically an insurance policy on a portfolio or on an individual asset. And the reason it's important, if you talked about insurance on your car, insurance on your house, people put insurance on those things knowing that there's a good chance they'll never need to use it, but it's there for protection. In the markets, in the financial markets, at some point in time, the assets you have, the portfolio you have, is going to be subject to a correction or a crash. But most people don't have insurance on the one thing that is going to have an issue. It's something that the institutions, all the pros use it. And for most of the people listening, you probably haven't been introduced to it by an advisor or by a brokerage firm.
Yeah, think about that, Al, because if investors had accounts in 2008, this past February and March, they probably lost a lot of money.
Sure. But
if institutions are insuring their portfolio, they probably didn't take those big hits like the public did.
Right. And the problem is, and Wall Street will tell you, don't worry about that because the market will come back. If you lost money in the year 2000, it came back right up until about 2007. Then it went down another 57%. And then sometimes it takes maybe 5 or 10 or 15 years just to get back to where it was before it went down. That insurance policy could have prevented the loss. So basically what we're talking about is saving you time. It's not creating a situation where your portfolio has to kind of dig out of a hole before any profits can be made. And by the way, a lot of people I know shy away from looking and doing this because they're afraid. And that is understandable when it's something that you don't know about. But here's one of the things that we want to make sure you understand. We teach a rules-based strategy. It's a step-by-step process, a set of rules that you follow that really gets you down to whether an investment or trade is a quality one you might want to look at or one to stay away from. And just to kind of simplify it, basically, you have the right set of rules. If the rules are met, you buy. If the rules aren't met, you don't buy.
Yeah, and you mentioned time earlier. Time is that one thing that we cannot get back. Time is that one commodity that just you can't get back. It's impossible. And with these phenomenal opportunities that the markets present with to the public and the institutions, they're out there. And people understand that they can take advantage of these. And if investors are new to the market, that's good, because with these investing classes, we bring terminology and make it more comfortable so people are able to make more confident decisions and confident choices with what they're doing, whether it's in their short term or their long term. So, Al, it's the last giveaway of the show. I want to give away one last set of tickets to this investing class where we explain how the financial markets work, how buying and selling occurs in supply and demand, why the institutions are doing certain things in their accounts, but also putting their clients in something that might be a little bit different. Al, hit me some words of wisdom.
Well, I did one of these classes this last week, and someone came up and said, gosh, I wish I'd known this before. I wish I'd done this 20 years ago. It's okay to say that. Just make sure that those are words you never repeat again. It's not over. It is just time to start doing something different.
Sometimes doing something different can be scary, but it's not new. It's just different. And Al, we got a big show next week. We're going to do market recap, talk about these other asset classes. Retire young, my friends. Thanks for listening. Don't forget to check out the website at retireyoungaudio.com and leave us a comment.